Let's bring in Karen Karniol-Tambour. She's Bridgewater co-CIO of sustainability. Karen, it's great to see you. Do you see all of these wild moves as tied to what the Fed is going to do?
Hi, Sarah. Yeah, I think we're entering a phase that's a really interesting phase and a tricky one because the economy is likely to do fine. Inflation is likely to remain high, but the Fed is withdrawing liquidity, is going to continue to withdraw liquidity. And we're really experiencing that sort of suck. When the Fed withdraws liquidity, it brings down asset prices. I don't think the Fed is likely to tighten enough to actually stop the self-sustaining momentum in the economy and get ahead of the inflationary pressures. It doesn't want to. It doesn't really want to cut off the expansion and cause a downturn. But it's been printing money for so long. There's been so many dollars floating around that removing liquidity, even if you're tightening sort of behind the curve, it really hurts assets. And we're experiencing that. And it hurts most, whatever's most liquidity sensitive, wherever you saw money go during COVID is what's reeling the most now.
Exactly how it's been playing out. So would you be buying on the dip then, Karen, some of these hard hit equities if you don't think the expansion is in danger and the Fed won't go so far as to kill it off?
No, I think you really could get a case where the economy outperforms financial assets, and financial assets just don't look nearly as good as they did, 6 months, a year ago, where the Fed had a lot of room to stay easy because they're going to stay in this, between rock and a hard place situation where they don't want to cut off the expansion all the way, but they really do have an inflationary set of circumstances to deal with. And the easiest way for that to play out is that financial assets just do worse than the economy, so they're less attractive than they were. In some sense, the most attractive assets are the ones most exposed to either inflationary pressures or the real economy. The best is exposure to kind of nominal spending, so things that are commodity exposed. But when you get real spending, when they're not cutting off the expansion, you're still getting people going in, buying things in stores, buying houses, you're getting inflation, but less exposed to the sort of financial excesses where that's where you see bubbles popping.
What commodities do you like, and what's the best way to get exposure? I mean, oil obviously has already had a very strong run. Maybe there's further to go, but it's pulling back today, I guess, showing a glimpse of the fact that it's probably not got as much upside as maybe some other commodities.
I think a broad basket is really most appealing. And for most investors that look at commodities, they end up overly concentrated in oil because that's the biggest piece of, say, the GSCI index. But oil has a lot of idiosyncratic risks. There are only a few big producers. Obviously, you have everything around climate change, which makes pressures sometimes to the upside, sometimes to the downside as regulations change and whatnot. I really like metals. I think they're somewhat ignored by investors because you need them in so much of what we need to use in the real economy. And you have these big structural pressures to say that even in a somewhat slowing economy, if we want to make any progress on climate change, we need more electric vehicles, more solar, all the things that require more physical inputs from the metals, which makes them particularly attractive in an inflationary backdrop that also needs to deal with all these environmental issues.